This is Trepp Wire Week in Review for week ending March 19th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, the economy seems poised for a spring rebound as some 90 million Americans have already received stimulus payments and states are reducing restrictions. Economic data was mixed. Philly Fed's manufacturing outlook jumped in March, but initial jobless claims were a miss and retail sales fell more than expected last month. And despite reassurance from the Fed that it had no plans to raise interest rates or taper bond buying, the 10-year Treasury yield jumped above 1.7%. Some takeaways from the Fed, Manus, were positive: an adjustment of the U.S. GDP growth and improved unemployment forecast.
It was an interesting week, to be sure, with the Fed and the FOMC meeting highlighting the middle of the week. On Wednesday, we saw stocks move higher after the meeting ended and Fed Chair Powell addressed the markets. At the time, to your point, he noted that GDP estimates were being upped significantly. The unemployment rate that they were predicting for year-end 2021 was, I think, under 4.5%, which is just extraordinary. They said no taper to their bond purchases for the foreseeable future, which is, the tapering is the kind of thing that in trader speak leads people to get their faces ripped off when events like that happen. And then also, near zero interest rates for the foreseeable future as well. So Wednesday, people looked at this and said, wow, this is all we could have dreamed of. And stocks jumped modestly on the news. They rebounded from being lower earlier in the day. And then it's almost like people went home, had their martini or their bottle of wine. They thought about it more. They said, let's go back to the tape and see what Powell really said. And they came in on Thursday morning and they said, wow, this is a real recipe for higher inflation. And before you knew it, on Thursday morning, the 10-year Treasury was up 13 basis points to 175. People were really spooked. Tech stocks were selling off. And it was a real reversal at that point. We're recording this Thursday late afternoon after the market has just closed, and there was pain everywhere, right? The NASDAQ was down 3%, Russell 2000 down 3%. The Dow held up fairly well, only down about half a point, but the S&P 500 down 1.5 points. So, we're in this kind of yin and yang right now where people are enthusiastic one day about the recovery, but the very next day they get a little bit uneasy about how much is too much, and are we going to see a 2 or 2.5 or 3% 10-year in the foreseeable future?
It reminds me of the old days a little bit. I remember back in 2012-ish, there was always, when the unemployment number came out or GDP number came out, nobody wanted it to be too good because they were afraid that would cause the Fed to start tapering. So good news is bad news and bad news is good news. This is a little bit different because now it's kind of playing out on the inflation side.
Well, it was an interesting week. The Fed's leading view of where GDP and unemployment were headed were really positive, but the broader economic news this week was not great, right? Surging unemployment claims, 50,000 or so above what people were expecting.
I think a lot of that came from Texas now.
Well, that could be.
From the storm?
That could be. I mean, there could be a seasonal effect here. Disappointing retail sales that also could have had a weather impact, a real drop off from the big print in January. And the Conference Board's leading economic indicators kind of fell short today. But as Martha said, the Philly manufacturing index was explosively higher. So a lot to digest. And I think you could make a real bull case right now, but you can make a real bear case too.
It's kind of one of those deals where you could almost imagine the economy, the real economy, going absolutely bonkers for the rest of the year, but stocks not, right? Because stocks essentially went bonkers for the last year, mostly in, tech names. And maybe we'll see those Dow names continue to do better, but I think they may have run their run already. I hope not. I will say I was out on a walk yesterday. I am about the heaviest I've ever been right now. Thank you to COVID and 2 kids and this whole thing. So I'm trying to get out and walk around a little bit during the day. It's hard with the interminable Zoom that we live in this world. But I was thinking, like, is this the time to just go completely opposite? Like,
Never get out of bed? Is that what you're saying? Instead of walking and exercise, you just
go
Eat a
Oreos,
Krispy Kreme.
the whole way. No, I'm thinking like everybody and their mother is saying that the economy is set for blast off, and it makes complete sense. And so everyone's saying that means that stocks, bonds, everything are just going to do great. Like, usually when everybody is saying something, that's the time to get a little worried. So I have no real deep thesis here, other than when the whole world is going one direction, like, you might want to just put a little cash on the sidelines for a couple months here, see what's going on. But then again, I also have the other side of that coin is I have a mantra in my investment account, which is never sell. So I'm kind of having an internal fight right now based on everything I'm seeing.
I'm picturing you like the grandparents in Charlie and the Chocolate Factory. Right? Remember the 4 of them? They'd all stay
Grandpa
in bed.
Joe.
Same bed.
They'd all stay in the same bed all day long. And I picture you instead of
but Grandpa Joe pops up when he realizes he's going to go to the chocolate factory. He hasn't been able to walk in 30 years. Now he's going to the chocolate factory. That'll be me when they reopen the movie theater down the street.
It's going to happen, April. So we're going to dig into some of the data, Joe, positive and negative, so that maybe by the end of this episode, you'll know
which way. I will be equally, if not more, confused.
You'll know which way you're going to go. In CRE data, we've been looking at some of the data there, and we see some more positive signs. Manus, what are some of the signs we're seeing that are a reversal?
Well, I'll caveat this with 1 month does not a trend make. And we try to talk about that with regard to special servicing numbers and delinquency numbers, that you do see blips every now and then. But I will point out some things that we did start to see in March that were encouraging. It seemed like new additions to special servicing were really slowing this month. It really seemed to trickle away. And it seemed like a lot of loans that had been in special servicing were making their way back to the master servicer. So that was an early trend. And when I say early, I was looking at this data when about half of the loans had remitted and reported. So maybe 250 billion out of a 500 billion set of loans out there. We saw a real diminishing number of borrowers throwing in the towel, right? We had said in the fall and winter that every month we were seeing a dozen or 2 dozen borrowers reach out to the special servicer and say, we're going to send the keys back. We're going to do a stipulated foreclosure. We're not going to contest anything. That whole plan of consensual default, that really trickled off. We saw very few of those in the last 2 months, which is a great thing. And lastly, we're starting to see more valuations come out that are at or above the loan balance. So we've talked about this in the past, that in the mall space, we've seen places where a new valuation comes in at 25% of what it had been at securitization and 50% less than what the balance is of the loan today. Now we're seeing some more positive things. I'll give a couple of examples. The Green Acres Mall, it's a big Nassau County, Long Island mall, has 260 million in debt on it. It was valued at 514 million at securitization, which I think was in 2013. The latest valuation came in at 357 million, which should be the kind of thing that keeps the borrower engaged as we come out of COVID. Another one, the $82 million Marriott Gateway Crystal loan. That's a almost 700 key full service hotel in Arlington, Virginia. The collateral was valued at 162 million in 2010. This month, it was lowered to about 107 million, giving the loan an implied LTV still of 77. So that loan makes up about 2/3 of the remaining collateral behind a 2011 deal. So the point here being, and I'll turn it over to Joe in just a minute to kind of add some color to this, is that these things are not coming in at levels where the borrower, their knee-jerk reaction will be, let's give back the keys. Their knee-jerk reaction when you see valuations like this are, let's see if we can extend the loan. Let's see if we can get some rate relief, maybe turn the loan to interest only. But this idea of positive or negative equity is a big driver in things like our default model, right? What percentage of the loans are going to default under baseline and moderately adverse and seriously adverse cases? And the same with the CECL loan reserves, right? These are the kinds of things that, Joe has spent a couple of years building out, to kind of indicate what losses will be. And to the extent that these things are coming in higher, that's a good sign that losses may not be as big as maybe we thought about 6 months ago.
It's funny you mentioned CECL. Back to our most favorite boring accounting topic of all time, which I've spent the last 6 years of my life on. It's actually like one of the less boring accounting topics, but it's still accounting. There was a big article in the Wall Street Journal about the large banks and how they are going to be able to unleash even more cash on the market because of the massive amounts of reserves that they had built up during 2020, and how as we come out of this, how you come up with the reserve now, thanks to CECL, it used to not be this way, is you have to basically have a forward-looking view of how the economy is going to perform. And then that forward-looking view will inform a bunch of models and math and magic that turns into an expected loss calculation on all of your loans, essentially your held to maturity debt securities. Now, coming out, now that we're in Q1 of 2021 and about to be in Q2, the forward-looking macro views of most of these banks are what we just talked about a few minutes ago, which is bonkers, right? Bonkers to the upside. So if they were truly quantitatively, doing this CECL calculation, you would probably see reserves drop 85%. You'll never see that because no accountant or no CFO ever wants to have massive volatility in their reserves, which causes volatility in their earnings. But I think you're going to see, a nice step-by-step drawdown of those reserves, which goes right into the earnings per share and becomes capital that can be allocated to loans. So it's it was a crazy time for this new accounting standard to come into effect right when COVID was starting, because you kind of saw like, holy crap, my reserves are going up by 5 or 10x, but I'm not sure how much of it is due to this new accounting standard versus due to COVID versus something else. So I think you're going to see similar confusion on the way down. Like, how much of this is due to your changing views of the macroeconomy? How much of it is due to the fact that, you've written down some of these loans already? And there's just so many different variables here. It's going to be, the moral of the story is going to be a lot more cash to be deployed by the banks.
Well, you also have the unknown, which we were talking about before we went live, which is, another unknown is what the Fed does with that supplemental leverage ratio, the SLR. And we're not going to get into that today because that's kind of a technical discussion. But in short, it impacts, the amount of capital banks must hold against treasuries and other deposits. That's set to expire at the end of this month. And nobody really knows what's going to happen with that. So that's another moving piece that banks will have to adjust for. And I think it's not easy right now to kind of figure out, as you said, what is COVID, what is CECL, what is SLR, and how does this all come together for you as a bank executive to give a decent picture to your investors, your shareholders, as to how the bank's performing, let alone the fact that you still have such opacity for, the data itself, right? What's delinquent and what's not.
Manus, you know that you can teach an old dog new tricks when you use the word opacity instead of opaqueness.
Yes.
I think I once corrected you on that, like in the early episodes. For you loyal listeners, you'll remember. But in terms of uncertainty, the only thing I care about right now for the next week is that mortgage rate that I locked in like a month ago, supposed to close on a loan next week on a mortgage. It wouldn't surprise me if they came back and said, oh, your paperwork got shuffled around and we lost it, and now all of a sudden your rate's 100 basis points higher. because the 10 years like 65 basis points higher than it was when they locked that rate.
Yeah, fingers crossed.
So turning to the lodging sector, we saw a number of stories that indicate possibly that we're seeing the beginning of some renewed interest in this sector.
That was my miss on what Manis just teed me up for before, which is if you want to see indications of green shoots, you watch when Blackstone does a big acquisition or a big disposition, right? They're usually pretty good at timing these things. So Blackstone is buying extended stay hotels with 50-50 with Starwood for $6 billion. So you got to think that things are looking up for the hotel space.
Yeah, it's interesting. When we were working on our outline, which we usually break within about 3 minutes of the podcast starting, we had written it up, or I had written up the original version of this in various property types with green shoots and brown shoots. And Martha wanted me to change the brown shoots reference to dandelions or crabgrass. So we're going to go through the property types where there's green shoots and crabgrass. So Joe mentioned one of the green shoots in hotels, this Brookfield Starwood JV buying extended stay hotels.
Blackstone.
Isn't it Blackstone Group?
Oops, Blackstone, yep. The interesting thing about that is you would expect in this work from home environment, this pare backing of business travel, this tapering off of conferences and sales visits for Zoom, that extended stay category would be the last to recover, right? We've been saying this for a while, right? The first to recover would be that vacation destination, right? The Orlandos of the world, Hawaii, Las Vegas, and so forth. And the last to recover would be conference cities and other places that CFOs had figured out, we don't need to put a guy on a plane, let's do a Zoom call. And so Starwood and that JV, those guys jumping in on this, I think is a big leap of faith that the office sector and the business travel sector will come back stronger than perhaps people like me believe.
So there was an interesting data point in the Wall Street Journal story about this, which said that extended stay in particular, their occupancy in 2020 was 74%, which is like crazy high compared to what we saw kind of across the hotel universe. So I have to assume that they have some, big corporate type tenants, and they, the journal article was talking about it was essential workers and healthcare people who were staying in these hotels and maybe keeping the occupancy up. So that's got to be a part of the calculus here, that it wasn't nearly as impacted as the rest of the universe, but I'm sure that their kind of perceived value was probably impacted more than their occupancy was.
So I'll give a piece of crabgrass on the other side of the extended stay hotel angle. So this was something we covered in Trepp Wire this week. It's not really extended stay hotel. It's more apartments, but I thought the story was kind of interesting. This is an apartment, a Manhattan apartment complex known as Beekman Tower. It backs a $63 million loan. The collateral is 178 units near the United Nations, Midtown Manhattan. So pretty good location. The property is not a pure comp to the rental market or the extended stay, but it is somewhat of a comp, right? It's heavily leased to corporate tenants. At securitization, 97 of 178 units were assigned to corporate tenants, and another 24 had leases for 6 months to 2 years. So this, really long-term thing. The property was valued at 146 million in 2018, giving the loan an LTV of 43 at the time. That valuation marked the apartments at about 820,000 per unit. Now, a Collier's appraisal from November of last year pegged the new value at 80 million on an as-is basis, which is about 450,000 per unit, and an as-stabilized number of 93 million for the complex, or 520,000 per unit. So what does this tell you? It tells me that somebody like Collier's doesn't see New York coming back in the next 2 years, because they're saying even in 2023, the value of this complex, which is heavily corporate tenanted, is only going to be 2/3 of what it was in 2018. And now maybe this is just a situation where New York is different from everywhere else, and New York has bigger problems structurally than other places. But to me, this is the other side of the coin from the extended stay hotel purchase.
Well, what's interesting, and the reason we brought this one up as well in Trepp Wire was because there was a modification done on the loan, right? So this modification looks a lot like those lodging modifications we've been seeing. So forbearance of principal and interest for 4 months, paid back over the next year, forbearance of or deferral of reserves, again, paid back for 4 months, paid back over the next year. The other thing about this that they mentioned is that because of the downturn in corporate demand, they are transitioning the property to be, fully residential. So I don't know if that has an effect on the Colliers, as stabilized appraisal, if the corporate housing had higher rental rates and that's why it was valued higher. But very interesting to see these types of modifications getting done. And I think something that we should do is look at all these forbearance deals that got done in the last 6 months and start to kind of figure out when the end of those forbearance periods are for each one of these things, and then follow up to see, are they starting to pay back, the foreborn P&I or reserves or whatever the case is.
So going back to one more hotel green shoot for people looking for another comp and another green shoot for what's happening in the market. We wrote about this on Thursday morning in a trading alert. Host Hotels bought the 448 key Hyatt Regency Austin for $161 million in cash. That represents a 10% cap rate. So for those trying to figure out how to value a hotel right now you have a bona fide cap rate to point to. I would call the Austin market a really strong one, that people expect that to come back really strongly over time. It's been a growing market. It's in a place where there's a lot of latitude for people to not be locked down. So maybe a 10% cap rate in Austin might equate to something more like 12 or 14% in, I don't know, Chicago or New York, but that's for investors to decide. The story came, by the way, from Real Estate Business Online. The story noted that it's a 20 to 25% reduction from pre-pandemic levels, but it is 92% of where this property was valued in 2017. And that's important because this property backs a $103 million 2017 CMBS loan that had been 90 days delinquent. So in this story, and I'm happy to share it with people if we want to give away a freebie for this week, 10% cap rate, the value is only 8% lower than where it was in 2017, and the sale will cure a $100 million defaulted 2017 loan. So that's a real green shoot.
Is that cap rate based on 2020 numbers, NOI?
They didn't indicate what the cap rate was based off of. It was just
because if it was based off 2020 numbers, that's probably more like a 15% cap rate in real life.
Yeah.
Right. When things
we can try to reach out to the writer and find out, but
it's like a good deal for both sides. Well, good deal for the lender, good deal for the buyer. I don't know about for the seller.
And a great deal for the CMBS bondholder who was looking at a distressed asset here.
In office, we had a lot of green shoots. Let's put it that way.
Yeah, we had a lot of really interesting stories this week. The one that came out today was that Columbia Property Trust had received a bid to be taken private for $2.2 billion. A group of investors that includes the Sapper organization, Arkhouse Partners, 8F Investment Partners made the offer, which is $19.50 per share. Bloomberg reported this first, but that story is behind a paywall. So if you can't get it, Commercial Observer does a nice summary of what's happening there. So that's a bet on the office market. Some other stories we were following this week. The Allen Center in downtown Houston has been refinanced with a $470 million loan. That has now found its way into a 2021 SASB deal. The property is a 2.3 million square foot complex. The renovation was completed in 2020. The new loan has an LTV of 54. A lot of the tenants are oil related. The property is 80% occupied, debt service coverage ratio 2.66, CMBX. The financing terms, a 2-year floater with 3 12-month embedded extension options. Brookfield owns the property. They contributed $230 million in equity over the last 6 years. Barclays and Citi provided the financing. Why does this story matter? And why do we talk so much about it? Well, Houston is a really lousy market for offices, and oil and gas tenants have been a real source of concern. So to see this get done is a nice deal, right? That even in a bad market with tenants that you may be concerned about, if oil goes back to $40 a barrel, they can still get financing. So that's terrific. A few other headlines. Brookfield, in this case, as a tenant, took 80,000 square feet at 345 Park. That's a story by Commercial Property Executive. The article called that part of the market beleaguered. So we're always happy when somebody takes 80,000 square feet in a beleaguered market. Health Information and Management Systems Society, HIMSS, took 30,000 square feet of sublet space in Chicago. That, according to the real estate journals, Avison Young brokered that deal. Why is that important? Well, we've been talking about how much sublet space is available in Chicago. Somebody who takes 30,000 square feet of that offline is a real positive sign, as small as it may be.
I don't think we've been talking about sublet space coming on the market for the last 3 months. I don't think we've talked about a story where we saw it getting absorbed.
Well, I'll throw one more out there. This is a personal note. The Sadia Group took 41,000 square feet at 275 Madison. Why does this one matter? This one matters because it was my
Let's take
first
a walk down memory lane.
It was my first Trepp office. Trepp had offices there on, I think, the 21st floor. And some of my memories, which were not always pleasant, were my first office roommate was a smoker. Back then, you were allowed to smoke in the office. And in winter, with the windows closed and this guy pumping out a cancer stick every 90 minutes, that was, you could only wear your suit one day before you could go to the dry cleaners. So that was one memory. Being asked by my boss to work through a bomb scare was another. We had a bomb scare on our floor, and he said, no, this project has to get done, and ignore those dogs that are walking around our floor trying to find the bomb.
They can't smell it through all the smoke.
And then we had a similar thing finishing up a project through a blackout where we had to walk down the stairwell with no lights at about 1 o'clock in the morning just to finish a project. So
someday you got to tell the stories about, sprinting to the FedEx place with your 7,000 teletype sheet model thing.
Well,
right?
The day ended at 8:50 because you needed those 10 minutes to get to FedEx. You draw straws earlier in the day to figure out who would run to FedEx. That person would run there, get there at 8:59, and then we'd all waddle over to 2nd Avenue to a place called Cold Waters, where they had the $9 pitchers of Schlitz that would take you, the rest of the way home.
The good old days. Wow.
Yes.
And let's look at some of the bad news. Fitch put out a report that talked about how work from home will impact CMBS credit ratings.
Yeah, so Fitch put out a report. We've been talking a lot about office in the last couple months, and Fitch put some numbers behind some of their predictions. They put out in terms of how net cash flow and value could potentially diminish based on a couple of different scenarios. They had a moderate scenario, which assumes employees work remotely a day or two per week, which turns into a 20% decline in office workers and a 10% decline in office space demand. The severe version basically doubles that. And with all of those kind of assumptions and inputs, they believe that net cash flow can come down anywhere from 15 to 30% across these two scenarios. And average market values could decline from 44 to 54%. These are some pretty alarmist numbers, or alarming numbers. I shouldn't say alarmist. It could be very, very well could be true. But, I don't know all of the math behind how they came up with all these different things, but you got to go check out the report. But it does give us a sense of, we haven't seen the reappraisals in office like we've seen in other asset classes. And I think it's just that long tail that we've been talking about. When a tenant that's paying, their lease comes up 2 years from now, if they've been doing a hybrid model, most likely they're going to be reducing their space.
So one other point about that report, Fitch estimated that 25% of investment grade bonds would potentially fall to sub-investment grade under the moderate scenario, and 55% would fall to below investment grade under the severe scenario. Now, this is something that the market is not pricing in at all, and I'll give you some examples of this. So the biggest concentration of offices in CMBX comes from CMBX 10, 11, 12, 13, and 14. All of those are very uniformed with 31 or 32% office as their collateral by balance. Now, the spreads on the triple B minus classes of those 5 CMBX indices range from about 350 for CMBX 14 up to about 550 for CMBX 10 triple B minus. Now, if there's anybody out there believing that office is going to see a 25 to 55% downgrade of triple B minus to sub-investment grade, you would expect these spreads in CMBX 10 to 14 triple B minus to be double what they are. Keep in mind that CMBX 6 triple B minus, which is the retail bet, that spread is 2,400 basis points right now. The CMBX 7 triple B minus is 1,200 basis points. So this is a thesis whose time has not come yet. But if anybody starts to buy into this thesis that Fitch is right, you would expect to see these CMBX 10 to 14 spreads just blow out very quickly.
And we had a number of other stories of offices that were reducing space.
So this is the other side of the coin. I gave some green shoots. Here's the crabgrass. JetBlue announced it was considering leaving New York City. It has a big presence in Long Island City, which we've mentioned in past podcasts is a real problem for multifamily. Long Island City was incredibly built up. Many complexes with more than 500 units, some with more than 1,000 units that have seen occupancy drop from the 90s to the 60s. JetBlue has a big corporate presence in that town. Them leaving is something to watch. Another story, another piece of crabgrass, Amita Health listed its 225,000 square feet of space in Lisle, Illinois for sublet. That's according to Cranes. And consumer electronics giant Belkin is reducing its space by 60% in Los Angeles. It's moving from Playa Vista, where it has 150,000 square feet at a Heitman-owned property, to 65,000 square feet at Aviation Boulevard in that town. That's a Tishman Speyer property. So just as there's bulls and bears in office, Fitch being probably the most bearish right now, you're seeing bullish stories and bearish stories. So I guess it makes sense.
Yeah, the last one that came across the wire today that Martha had sent around was that Ford had announced that they are going to allow some sort of flexible work arrangement for 30,000 employees. It had a little bit of a scarier headline when you actually read the article. It said that they're going to go to some sort of flex, half in, half out, work from home, work from office type deal. But, just multiply that by the 1,000+ million companies that have office space. I think everybody's going to have some version of this in the future. So while it may be kind of alarming, I think the Fitch concept is not a crazy idea.
It wouldn't be surprising if somebody jumps in and makes that a short thesis, right? The carrying cost is not extraordinary like it is for malls. And it is something that is not out of the question.
I guess it's just one of those deals where you don't expect the losses to happen for a while, right? You'd have to figure out which one of these has big maturing office loans in the next couple of years or do the thing where you short it and then publicize your short and hope people jump on it and, the spreads kind of come out a little bit.
We published a piece this week on the state of CMBX 6, which has almost 60 loans backed by malls. What did the update show?
Well, what we tried to figure out was we mentioned a minute ago that the spread on CMBX 6 triple B minus was 2,400, which is almost at its all-time wide. It's been widening all week this week, so it's really approaching that high watermark at this point. So everybody's expecting the worst in the mall category. So what we tried to do was put out a piece that said, if only the malls default, and they only default at levels that we're seeing now in terms of reappraisals, right? The reduction in appraisals that we've seen on CMBX 6 loans thus far, is that enough to wipe out the triple B minus classes and really pay off that triple B minus short? And the answer is maybe, right? It was a resounding maybe. And the headline for us was that thus far, the reappraisals of the malls, while there have been a couple of catastrophically low valuations, some have been nice. Some have been close to the loan balance that have offset that. And what we said is, our conclusion was that if all the malls blow up and basically nothing else blows up, or very little blows up, and the losses amount to the average reappraisal that you've seen thus far, a lot of these triple B minuses will not be wiped away. So for the triple B minus short to really cash in, and cash in means that, you're wiping out the triple B minus category or class, one or two things in addition have to happen. Either these valuations have to fall more than we've seen thus far. And to be fair, we've only seen about 10% of the mall loans reappraised thus far into the cycle, or they have to see sizable losses from other categories like offices and hotels if these mall losses kind of come in line with the valuations we're seeing thus far. So we didn't really make any conclusions. We were just kind of painting a picture so that longs and shorts, or maybe would-be longs and shorts, had a sense of how this could play out under different scenarios.
Yeah, I mean, the other side of that is that you're kind of basing this analysis on the reappraisals you've seen so far. Oftentimes, you'll see two reappraisals, especially on these loans that take a year or two to get worked out. And when those loans do take that long, you very, very rarely see the second appraisal higher. It's usually decently lower.
Right.
Last month, Winter Storm Uri had a widespread impact with particularly damaging consequences in Texas. And those of you that were listening to us a couple weeks ago heard Lonnie talking about it firsthand on the ground. They had power grid failures and the largest blackout in the country. And this week we released a report highlighting the environmental composite risk scores that we've integrated from our partner RMS.
Yeah, quickly, before we get into that, I just want to say that I was on a call with Lonnie yesterday at about 4:30 in the afternoon, and he said, you know what, it's 80 degrees out. My wife and kids are in the pool in the back. So,
He gets no sympathy.
That's right. So we actually integrated this several months back. We have a sister company called RMS, and they generate all sorts of environmental risk scores based on location and based on property. They also have all sorts of other risk scores. They're used a lot by insurance underwriters when underwriting property insurance. But what we've done is mapped several of their kind of environmental risk factors to our CMBS properties. And it's something that is currently being used by a couple of clients to measure the E risk in their portfolio. So if you want to learn more about that, just check out the piece. I think it's a blog, or just give us a shout at podcast@trepp.com.
And looking at the deal of the week.
Deal of the week.
Yes, let's talk about the deal of the week. This comes courtesy of Real Estate Journals. This has to do with law firm Nixon Peabody taking an additional 70,000 square feet at 70 West Madison in Chicago. Earlier in the podcast, we noted that Chicago has really been hammered by enormous amounts of sublet space on the market. So we like to, in our deal of the week, talk about good news. So this was done by the Telos Group and Newmark. Jamie Dix, Caroline Cullen, and Steve Goltz represented the landlord in this transaction. Bob Chadas, Steve Levitas, and Bill Anderson from Newmark represented Nixon Peabody. Nixon Peabody was already a tenant in the building, and this adds 72,000 more square feet to this. And we're really happy to report that story.
So let's do shout outs, and there are plenty. So I will walk through some of them. Black Eagle via Twitter, they actually shouted out a couple of our programs that we have for undergraduate students that are interested in commercial real estate or commercial real estate finance, our brand ambassador program, and future leaders. So if you have an interest in that or know a student who might have an interest, send us an email to podcast@trepp.com and we'll give you the details. We had Yanni Yu reach out, Robert M. And Robert M., I think his email is going to have a special place in my heart. He basically said that he's been listening to the podcast from the beginning, and he started during the worst part of the pandemic. So it's one of the reasons he loves listening to it. He says there's a mysterious alchemy at work amongst this group. Joe?
There is a mysterious alchemy in this podcast, and we will never reveal what that is.
Well,
No.
I'll digress for just a moment that yesterday, Joe and I were in the same office and we had to do a call, and we realized that we had only one microphone. I had not brought my industrial strength, first-rate microphone. So rather than make our clients listen to something substandard, we did the whole Bruce Springsteen, little Steven Van Zandt, barking into the same microphone to two hearts.
That does
I
beg
hope
the
Joe
question.
I hope Joe got his vaccine before I took to the mic.
You breathed into the microphone. That does make me ask, when we are back in the office, there's no way that all of us can be in the same room recording this. So that's going to be a problem. So Jonathan S. via Twitter, he says this is his go-to podcast. Thank you, John. He tweeted Tripwire, #strong. Cullen N. Also, I think Joe probably feels a little special because he said he felt when he met you that he was meeting a celebrity. So you finally got the love that you've been wanting to get.
I don't need no love. You guys can give all your love to Manus. He deserves it.
Nice. Alec P. He loved the recent educational segment we did on gross rent multiplier and did a nice article that plugged the podcast. So thank you for that. A number of people loved the Don Sheets pod.
I think that Don Sheets interview last week was one of our best guest pods so far. I have to say.
Careful, you're going to offend all our other.
No, I mean,
former
one
guests.
of the best, obviously. You've all been great. Here's the real question. How many of our guests are actually listening?
You watch, you'll
Right?
get a few.
I'm sure Don is going to email us and say, I'm listening.
You're going to get a few.
This is a test for the rest of you.
So Brad C, Will C, Michael W, Graham O, Hillary N, all thanked us for keeping up the good work on the podcast. Thank you for that recognition. We do appreciate it. And, guys, it's back. I'm talking about March Madness. After a 1-year pause, we're back to the bracket challenge. Hopefully you've done a little bit of research. You've had some time to collect, 68 teams and what their records are and what their average points per game are and what the likelihood is that they'll make it through the rounds. Manus, I'm going to start with you.
I don't know if people noticed, but this year they messed with the recipe. It used to be 32 games on Thursday, 32 games on Friday, starting at noon. And I looked forward all week to sitting down on my couch, watching, that 12 o'clock game, watching it kick off. Just remembering all those great days in the office where you couldn't wait to get into the office and talk to your buddies. You go out for lunch, you'd watch a few games. This year, the first Thursday is these out 4 games, right? They're kind of the preliminary games. So it doesn't have that same kickoff, right? I always equated that first day, that Thursday, right up there with Thanksgiving, Christmas, pitchers and catchers reporting, Halloween, right? It was right there, and they've kind of messed with the recipe. I hope it doesn't ruin it. But I'm looking forward to games this week. And by the way, Joe, I know you have young kids at home. I'll tell you the worst 3 days of the year:
You can skip those.
dance recital, piano recital, Christmas pageant. Right? Not necessarily in that order.
I don't know.
I hope your children are listening to this,
I was going to
Madness.
say primary school band is right up there.
Yes. So my picks, and nobody should forget that how much I bungled my Super Bowl pick. So
True.
take
And
this
nobody
with
should
me.
forget how well my Super Bowl pick was, and Martha.
And mine.
So here we go. For me, it's Gonzaga, Florida State, Houston, and
Ooh.
UNC.
Oh, wow. That's out of
And
nowhere.
dark horses, Iona, UConn, and Ohio. Not Ohio State, Ohio. And I'll give one more shout out. I have a go-to guy, BS, who has been absolutely right on thus far on where he would see spreads going, delinquency rates, special servicing numbers. And he also happens to be a real big college hoops guy. And he emailed me, knowing I was going into the podcast. He gave me Gonzaga, Baylor, Texas, and Illinois.
Oh,
Not-
those are mine except for Alabama. I got Alabama instead of Texas, but
He's not buying the Big Ten hype, he said.
no. Yeah.
All right, what do you got, Martha?
I got Gonzaga, Baylor, Alabama, and Illinois with Gonzaga taking it all.
And who's your dark horse?
I wrote that down. Didn't I send it to you? Because I'm going to say one and I'm afraid I'm going to not be honest and say a different one. So keep me honest. They're not
I
that.
thought you said Georgetown.
Oh, that was it. See, I told you I would say a different one. I did say Georgetown, and I have a reason for that. My husband's a Georgetown alum, so I kind of feel compelled. Otherwise, he might not talk to me.
Not a big deal.
What's a Hoya?
Exactly. He loves it when we say that.
This reminds me, your kickoff mention reminds me, Manus. I was once at Boston College as a freshman, and I was in my intro to theater class, sitting behind my friend Mike. And it was like the Thursday of March Madness. And I had my computer open watching like 17 games all at the same time. So I do totally understand that. I will say that, when I was younger, I used to like gambling on sports. I probably still would like gambling on sports, but I don't do it. So you add that plus the 2 kids, plus the, when I first started at Trepp as an intern and other times, like I could spend 6 hours playing fantasy baseball, right? Or figuring out my brackets or doing a Super Bowl pool. Now, they're getting every ounce of my brain power. So I can't even think about what's going to happen in March Madness other than I'm going to root for Iona.
So we'll see which one wins besides BS. I don't know if is that bogus, Manus? BS?
No, that's for real.
Okay. just
That's for
checking.
real.
All right. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or comment, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.